Imagine 3.5 million barrels every single day.
It's a massive amount of fluid.
Right. I mean, that is a literal river of toxic subterranean water, and it's entirely encased in steel, moving through the Texas desert 24/7.
Yeah, and keeping it moving is not easy.
Exactly. We aren't looking at some small operation here. The logistical choreography required to maintain that kind of pressure, keep the fluid dynamic, and honestly just prevent a catastrophic system failure, it's staggering.
And the crazy part is that's just the physical baseline.
Yeah.
When you look at the Q3 2026 earnings call for NGL Energy Partners LP, the physical movement of the water is almost secondary to the structural overhaul happening.
Yeah.
I mean, we're looking at this incredible case study in aggressive corporate metamorphosis happening on the balance sheet and the boardroom.
Okay, so let's unpack this, because anyone holding or even just evaluating midstream equity right now needs to understand what's happening here. This isn't your standard, pipeline toll road update.
Yeah.
We are diving into an entity that is actively amputating its legacy businesses. They are deploying machine learning to manipulate fluid dynamics across hundreds of miles of pipe, and arguably the wildest part of this whole thing.
Oh, I know where you're going with this.
Right, exploring the use of waste heat from nuclear reactors to desalinate Permian Basin wastewater. It's wild.
It really is an intersection of heavy industrial mechanics, high-level capital discipline, and environmental technology all crashing together.
Yeah, but we should probably ground this in the raw numbers first, right? Because none of this sci-fi future stuff happens without cash flow.
Exactly. The Q3 adjusted EBITDA from continuing operations is what gave them the runway to even pursue these futuristic avenues. So they posted $172.5 million.
Which is up, 9.2% from the $158 million in the same quarter last year? So a solid beat.
Yep, a very solid beat.
But the thing is, that aggregate number completely masks this violent divergence happening underneath the hood.
Oh, completely.
If you isolate just the water solutions segment, you've got $154.5 million, which is up 16.5% year over year. So water is basically doing all the heavy lifting.
Right.
Meanwhile, you look at crude oil logistics, and that sits at just $15.4 million. And liquids logistics is at $15.2 million. So both of those legacy segments are shrinking.
And what's fascinating here is that normally that triggers a massive sell-off.
Oh yeah, panic in the markets.
Exactly. If a midstream operator sees two of its three core segments contracting, the market assumption is, market share degradation, or maybe a severe counterparty failure.
But not here.
No, not here, because that shrinkage is entirely calculated. Management is effectively burning the boats.
Right. Going back to that April 2025 strategic repositioning, I mean, they dumped the wholesale propane business. They sold off 17 NGL terminals. They completely exited refined products, and they started winding down the biodiesel marketing.
They essentially took a chainsaw to their own diversification.
Yeah. Today, on the liquid side, they're basically just anchored by the Centennial butane blending business. Everything else is just gone.
It is a ruthless pursuit of the pure play multiple.
I've got to push back on that, though, because, in energy logistics, diversification is usually your downside protection, all right?
Sure, traditionally.
If you've got crude, refined products, propane, and water all flowing through your infrastructure, a massive contango in the crude market or some regulatory hit to water disposal doesn't bankrupt you. The other segments prop you up. So aren't they creating a single point of failure by stripping this down to essentially a water utility?
I see why you think that, but that assumes all those revenue streams are equal in quality. And the reality is they aren't. Let's just look at the WACC, the weighted average cost of capital implications of that propane business they shed.
Okay, break that down for us.
So propane distribution is notoriously seasonal. It relies entirely on heating degree days. You get a mild winter, your cash flows completely trader. You get a harsh winter, they spike.
Which introduces heavy cyclicality to the balance sheet.
Exactly. And capital markets severely penalize cyclicality. Unpredictable cash flows mean you have to hold more cash in reserve, right? Your cost of debt is higher, and your equity investors demand a higher risk premium.
That makes sense.
So by shedding those weather-dependent commodity segments, NGL isn't actually becoming less resilient. They are manufacturing durability. Mike Krimble, the CEO, made this totally explicit on the call. The pivot to a predominantly water solutions footprint Strips out all that seasonality.
Oh, I see. So they're re-rating the stock. They're moving from being a cyclical midstream logistics player to something that behaves a lot more like a municipal water utility.
That's exactly it. Utilities command premium multiples because the cash flow is guaranteed, regardless of macroeconomic conditions or commodity pricing. So they're trading low-quality, diversified revenue for high-quality, concentrated revenue.
Wow. Okay. And the durability of that water revenue becomes incredibly clear when you actually look at the physical operations this quarter. Because I mentioned that 3.5 million barrel a day figure at the start.
Yeah, that's a huge number.
They set a physical disposal record, processing around 3.07 million barrels per day on average, which is up 17.1% year over year. But the real flex was Doug White, the CRO, noting they eclipsed the 3.5 million mark in a single day in early January.
And we have to be clear, that volume surge didn't just happen organically. It was structurally enabled by the Western Express pipeline expansion.
Right.
We were talking about 27 miles of 24-inch pipeline that was executed ahead of schedule and under budget.
Which, let's be honest, is practically a miracle in modern infrastructure development. Nobody builds under budget anymore.
Truly a rarity.
But let's dig into the geology of why they laid that 24-inch pipe, because it's not just about rock capacity, it's about routing.
Yeah, the geology of the Delaware Basin is becoming a massive bottleneck for producers. The sheer volume of produced water coming up alongside the hydrocarbons. I mean, sometimes you're looking at 3 to 5 barrels of water for every single barrel of oil.
That is insane.
It is. And all that water has to be injected back underground into saltwater disposal wells. But you're dealing with immense subterranean pressures.
And seismicity, right? Earthquakes.
Exactly. If you inject too much fluid into a constrained geological fault zone, the pore pressure builds up, the rock slips, and suddenly you induce an earthquake. The regulators in Texas and New Mexico are actively throttling injection permits in these high-risk seismic areas.
So the Western Express expansion basically allows NGL to take that produced water from those highly constrained, seismically active zones and aggressively route it outward to areas with much higher geological absorption capacity.
Right. It's an internal relief valve for the entire basin. If they didn't have that routing flexibility, the producers would literally have to choke back their oil production.
Yeah.
They just have nowhere to put the water.
But speaking of keeping things flowing, I want to pivot and talk about that mid-January freeze. The Midwest and Southeast got hit with that massive cold weather system. Equipment freezes, roads turn to ice, and field operations basically just grind to a halt.
It was brutal.
And during that freeze, NGL's physical disposal volumes dropped below 3 million barrels a day. Yet Brad Cooper, the CFO, flat out stated the weather event wouldn't materially impact their full-year financial guidance. How did that work?
That is the power of their contract structuring. NGL leans incredibly heavily on MVC's minimum volume commitments and CBCs, which are capacity block contracts.
Okay, so how much volume is protected there?
Over 1.5 million barrels a day are fully protected under those structures. It completely insulates the top line. Basically, a producer secures the pipeline and disposal capacity, guaranteeing NGL they will slow, say, 100,000 barrels a day.
Right.
If a freeze hits and the producer's wellheads freeze up and their flow drops to 40,000 barrels, they still have to write NGL a check for the full 100,000.
The deficiency volumes.
Yes, exactly. Cooper actually noted that the total volumes they were paid for, including those deficiency volumes, were 3.13 million barrels per day compared to the actual physical flow of 3.07 million.
Okay, so here's the cynical take. If you're holding NGL equity and you know you've got these ironclad take-or-pay contracts covering half the basin, don't you secretly root for weather delays? I mean, think about it. If a blizzard shuts down the Permian, the producers still pay the MVCs, but NGL doesn't have to run those massive electric pumps. They save on OpEx, they reduce wear and tear on the valves, and they collect the exact same check. It feels like an arbitrage on operational downtime.
Well, from a purely spreadsheet perspective, yeah, you could argue that, but operationally, it's an absolute nightmare. The wear and tear actually increases during a shutdown.
Wait, really? Because of the homeostasis of the system?
Yeah. Fluid dynamics dictate that a massive pipeline network wants steady, continuous flow. When you drop the pressure and the fluid becomes stationary, especially in sub-freezing temperatures, you face immediate thermodynamic risks.
Oh, because it freezes.
Right. Brine has a lower freezing point than fresh water, sure, but it will still freeze if it gets cold enough, and when it does, it expands.
And a burst 24-inch steel pipe probably costs a hell of a lot more to remediate than whatever you saved on electricity for the pumps that week.
Exponentially more. Plus, when the flow stops, Sediment and solids that are suspended in the produced water begin to settle out. They accumulate in the low points of the pipeline and around the valve seats.
That sounds like a mess.
It is. When you try to spin those massive multi-thousand horsepower pumps back up, you are fighting increased friction and potential mechanical blockages. The maintenance capex required to recover from a hard freeze will instantly wipe out whatever variable OpEx savings you got. Management wants that water moving. The MVCs aren't some sneaky arbitrage play, they're just baseline insurance.
That makes total sense.
Yeah.
So that durability getting paid whether the fluid moves or not is exactly what's funding what I think is the most impressive part of this entire earnings call.
Let's look at the balance sheet cleanup.
It's massive.
The financial engineering happening here is just aggressive. Oh, absolutely. They've pulled leverage down to the low 4.0x area. Getting debt to EBITDA down to 4 times is a massive psychological threshold for midstream operators. But it's not just the senior secured debt they're attacking, it's the actual composition of the capital stack.
Right, because they redeemed roughly 15% of their Class D preferred units. And preferred equity is such a brutal drag on common shareholders. It just sits there between the debt and the common stock, sucking up this massive fixed dividend yield. It's essentially expensive mezzanine debt wearing an equity mask.
That's a great way to put it. And by redeeming that 15%, they immediately cauterize a massive cash fleet. They're permanently lowering their cost of capital. And the cash they free up from those preferred distributions is being directly routed into common unit buybacks.
Yeah, in Q3 alone, they bought 1.6 million units. Since the inception of the program, they are at 8.7 million units retired at an average price of $5.70.
That is nearly 7% of the total outstanding float just erased.
Right. It creates instant scarcity value. But the real masterstroke, the move that shows true capital market sophistication on this call, is the warrant trade.
Oh, the warrant trade is brilliant. We have to look at the math on this because it's a wildly asymmetric bet. So in November 2024, they spent $6.9 million to buy back 23.3 million long-term warrants.
Yeah, and the strike prices on those warrants range from $13.50 to over $17. So for an equity trading significantly below those levels, it's really easy to look at those warrants as deeply out of the money and basically harmless.
Right.
So why spend $6.9 million of hard-earned cash flow to buy paper that isn't even exercisable right now?
Because of the overhang. Institutional investors run blind skulls models on a company's equity. Even if a warrant is deeply out of the money, it represents potential future dilution. It acts as an invisible ceiling on the stock price.
So it's dragging down the valuation today.
Exactly. If NGL executes perfectly, they grow their EBITDA and the stock price rallies toward $14. Suddenly, those warrant holders exercise. Millions of new shares flood the market, expanding the denominator and instantly diluting the cash flow per share for the common equity holders.
It just kills the momentum.
It mathematically caps the upside. By stepping in and spending a mere $6.9 million to retire 23.3 million warrants, management eliminated 18% of their future dilution in a single transaction.
You combine that with the open market unit buybacks, and they have effectively vaporized 25% of their total equity dilution. I mean, think about the capital discipline that signals.
It's rare.
Instead of taking that $6.9 million and plowing it into some speculative pipeline extension or, a risky M&A deal to empire build, they used it to perform cosmetic surgery on the cap table.
Yeah, it's like watering down a drink at a bar. NGL is basically taking the water out of the cocktail, making every single remaining share more potent. Every remaining common share now has a 25% stronger claim on the free cash flow generated by those water pipelines.
It radically fundamentally alters the investment thesis. But what makes this really compelling is that they aren't just squeezing efficiencies out of the financial plumbing, they are squeezing it out of the physical plumbing too.
Which brings us to the operational expenses and the AI integration.
Right. OpEx dropped to an incredibly lean 18 cents per barrel. Brad Cooper credited some non-recurring expense roll-offs, but Doug White was absolutely adamant about the impact of their AI and machine learning project.
Yeah, he stated, we are now in the second year of this deployment, and it's going to significantly contribute to operational efficiency this calendar year.
And I have to say, I am naturally deeply skeptical whenever a heavy industrial company suddenly starts touting AI. 9 times out of 10, it's a management team just trying to bait algorithmic trading bots into buying their stock by saying the magic letters.
Oh, absolutely.
We're talking about a company that pushes dirty water through steel pipes. How exactly does a large language model help with that? Is this just management dropping a buzzword?
Well, it doesn't. Because this has nothing to do with generative AI or language models like ChatGPT. This is applied industrial machine learning. They're leveraging millions of data points pulled directly from their SCADA systems.
The supervisory control and data acquisition architecture.
Exactly, the system that monitors the physical state of the network. So they're feeding in raw telemetry, pump speeds, valve pressure, ambient temperature.
Okay, that makes more sense.
And crucially, real-time electrical grid pricing. Electricity is one of the single largest variable costs for a midstream water operator. Running a 5,000 horsepower electric pump to force water down a disposal well draws an immense amount of load. The AI model is designed to optimize physical fluid dynamics against economic variables.
Oh, I see. So instead of a human operator looking at a screen and deciding to turn a pump on just because the tank is getting full, the AI is looking at the ERCOT pricing grid. It sees that power is surging to $200 a megawatt hour right now, and it decides to throttle back the pumps at this specific substation.
Exactly. It uses the pipeline network itself as temporary storage, letting the line pack build up pressure slightly, and then it ramps the pumps back up at 2 a.m. when the wind is blowing, industrial demand drops, and power prices literally go negative.
That is brilliant. It's dynamic load shedding applied to heavy machinery.
Yes, but the implications go way beyond just shaving a few cents off the power bill to get to that 18-cent OPEX. If we connect this to the bigger picture, when you look at how machine learning interacts with fluid dynamics, it actually starts affecting the capital expenditures.
How so? That's the hidden leverage, right?
Right. A human engineer will typically operate a pipeline with a massive safety margin. If a 24-inch pipe is rated for a certain pressure, the human operator might only run it at 80% utilization.
Because they can't instantly calculate all the ripple effects of a pressure surge originating, say, 50 miles upstream, they have to leave a 20% margin for error.
Because if they're wrong, the pipe bursts, and they are facing an absolute environmental disaster. But a machine learning model, digesting microfluctuations in pressure across thousands of sensors simultaneously, can model the fluid dynamics in real time. It can safely push that utilization up to 92% or even 95% without ever crossing the physical safety threshold.
So if the software can find 50,000 barrels of hidden capacity inside the existing steel, NGL doesn't have to spend $10 million drilling a new disposal well or laying a new gathering line. The software is physically increasing the capacity of the hardware.
Exactly. It is pure operating leverage. Increasing utilization on existing assets goes straight to the bottom line and drives up the return on invested capital. That is why that 18-cent OPEX number is so critical. It proves the integration is actually yielding physical results. It's not just acting as a buzzword in a slide deck.
And they're going to need every single ounce of that efficiency because the sheer volume of water they're handling is pushing the limits of the geology, which brings us to the management guidance and the pivot into nuclear technology.
The sci-fi part.
Right. So they reaffirmed the fiscal year 2026 EBITDA guidance of $650 to $660 million. But the real headline was projecting fiscal 2027 to exceed $700 million for the first time in company history.
But, Mike Krimble spent a significant portion of the call discussing the existential wall the industry is going to hit. You just cannot pump an infinite amount of water into the subterranean formations of the Permian Basin forever.
The poor pressure problem we talked about earlier.
Yes. We touched on the seismicity with the Western Express routing, but routing only buys you time. The aggregate volume of water being injected is fundamentally altering the geomechanics of the basin. The rock is simply saturated.
So what's the end game? If the oil companies keep drilling and the water keeps coming up, but the Earth literally cannot take it anymore without triggering magnitude 5.0 earthquakes, what happens?
You have to treat the water on the surface. You have to clean it up to the point where it can be beneficially reused, whether that's agricultural irrigation, industrial cooling, or eventually actual municipal drinking water.
Wow.
And that requires a technological leap that standard midstream companies are entirely unequipped to make.
Which introduces the NATRA MOU, the Memorandum of Understanding. Here's where it gets really interesting, where the earnings call basically reads like a sci-fi novel.
Yeah.
NGL is partnering with NATRA to use nuclear power to desalinate the produced water.
Yeah, and an analyst on the call was clearly spooked by this. They asked about the massive capital costs associated with nuclear projects.
Well, the analyst's apprehension is completely justified, right? Nuclear projects are notorious for billion-dollar cost overruns and decade-long regulatory delays.
They are. But we have to look at the specific thermodynamics of what NGL and Natra are proposing here.
Right, because standard reverse osmosis, the way most coastal cities desalinate ocean water, doesn't work here.
No, not at all. Reverse osmosis pushes water through a semi-permeable membrane. But the produced water coming out of the Permian isn't just salty ocean water. It's a hypersaline brine, heavily loaded with heavy metals, hydrocarbons, and total dissolved solids.
It would just destroy the equipment.
It will literally shred an RO membrane in hours. The only way to clean this specific water at scale is thermal desalination.
Meaning you have to boil it.
You have to boil millions of gallons of brine, capture the pure steam, and then condense it. The amount of thermal energy required to do that via multi-effect distillation is just staggering.
And historically, you'd have to build a massive natural gas power plant right next to the water facility just to generate that heat. You'd be burning incredible amounts of hydrocarbons just to boil water, which completely destroys the economics and creates a massive emissions footprint.
Which is exactly where the brilliance of the nuclear synergy comes in. A nuclear reactor fundamentally is just an incredibly efficient rock that gets very, very hot.
Right.
Generating electricity is actually a secondary process using the Brayton or Rankine cycle. Roughly 60% of the total thermal energy produced by a standard reactor is wasted. It is just blown off into the atmosphere through those massive cooling towers.
So NGL's plan is to co-locate with a natural small modular reactor and capture that 60% waste heat. The nuclear plant generates clean baseline electricity to sell to the Texas grid, and NGO takes the free zero-carbon thermal exhaust and uses it to boil the toxic brine.
Exactly. It's the ultimate industrial symbiosis. You are combining two massive waste streams, nuclear thermal exhaust and oil field-produced water, to create fresh, usable water.
And the political tailwinds for this in Texas are massive right now. I mean, the state legislature just passed $1 billion water bill. Texas is experiencing explosive population growth, massive industrial onshoring, and severe structural drought. If NGL can convert toxic oil field waste into clean municipal or agricultural water, they instantly become one of the most critical ESG infrastructure players in the entire state.
And that is just the water side of the equation. Management dropped another massive detail on the call. When you boil off the pure water through thermal desalination, you're left with an ultra-concentrated brine slurry.
Right, the heavy metals.
Yeah, they explicitly stated their intention to extract critical minerals from that concentrated brine. These ancient subterranean aquifers are rich in lithium, iodine, and other rare earth elements.
Wait, really? So with the federal government throwing billions of dollars into securing domestic supply chains for battery metals and critical minerals, NGL is essentially getting paid to pump a lithium feedstock out of the ground. They are getting free heat to concentrate it and creating clean water as a byproduct.
It completely flips the economic model of the company on its head.
But again, circling back to that analyst question, who actually pays for this? Because small modular nuclear reactors aren't cheap. Management
was crystal clear on the CapEx structuring. NGL will have zero capital expenditure obligations on the nuclear generation side.
Wow, zero.
Zero. Natra is responsible for the financing, the construction, and the regulatory approval of the reactor. NGL's role is strictly to provide the guaranteed flow of water and offtake the heat.
So they're essentially acting as the toll road for the feedstock. And they aren't going all in on day one either. They're starting with a proof of concept, a 50,000 barrel a day treatment facility powered initially by natural gas.
Right. They'll use that pilot plant to dial in the thermal distillation mechanics, secure the long-term offtake contracts for the fresh water and the minerals, and then, once the revenue is legally locked in, Natra brings in the nuclear asset to scale it up.
It drastically reduces the execution risk. And we really shouldn't forget NGL has institutional memory here. Management reminded the analysts that they successfully ran a massive water treatment and desalination project in Pinedale, Wyoming for years.
That's a great point.
They understand the complex chemistry of cleaning produced water. This isn't just a pipeline company randomly guessing at advanced chemistry. It's a return to form, just using next-generation heat sourcing.
And if they pull this off, the re-rating of the stock will be violent. You're talking about transitioning from a fossil fuel logistics multiple to an environmental tech and critical minerals multiple.
But we have to ground this back in the reality of today's market. Let's look at the final verdict on the core business, because there's a macro dynamic playing out in the Permian right now that is fundamentally altering NGL's risk profile.
Yeah. An analyst from JP Morgan brought up the Devon energy consolidation. Over the last 24 months, the Permian has seen massive M&A activity. The large-cap public producers like Devon are buying up the smaller, private, equity-backed drillers.
Now, how does that actually impact NGL's pipe flow? Because a barrel of water is a barrel of water, regardless of whose name is on the wellhead, right?
Well, the volume might be the same over a long enough horizon, but the cadence of the flow changes entirely. Private equity operators are highly erratic. Their goal is usually to drill as aggressively as possible to boost their production numbers, flip the company to a larger buyer, and exit.
Oh, I see.
So when oil prices are high, they frack everything in sight. When prices drop, they completely lay down their rigs. It creates violent boom and bust cycles for the midstream operators servicing them.
Meaning you have zero visibility into your throughput 6 months out.
Exactly. But when a massive public company like Devon acquires those assets, the erratic behavior stops. Public companies prioritize returning capital to shareholders via steady dividends and share buybacks. They run their drilling programs like a factory assembly line. They maintain a flat, predictable cadence of drilling and completion, regardless of short-term volatility in WTI crude prices.
So the consolidation actually institutionalizes NGL's cash flow. It makes the volume highly predictable. But there's a quirk to this that I found absolutely fascinating. Management noted that when fracking activity actually slows down, say during a macro pullback or a weather delay, NGL's disposal volumes actually spike.
It is a completely counterintuitive dynamic. You would assume less drilling means less water.
Right. If they aren't completing new wells, where is the extra water coming from?
It comes down to the closed-loop recycling systems that modern frac crews use. When an operator fracks a new well, they need millions of gallons of water to pump down hole and fracture the shale. Sourcing fresh groundwater for that is incredibly expensive and, frankly, politically toxic.
Makes sense.
So the operators take the produced water flowing out of their older existing wells, lightly treat it on the surface, and pump it directly into the new well they're fracking.
So they're recycling it. The water never actually hits NGL's disposal system.
Precisely. It creates a massive bypass loop. But if the operator pauses their completion crew, maybe they were waiting on a sand delivery, or oil prices take a quick dip, or freeze halts operations, that recycling loop is instantly broken.
Because the old wells are still producing water 24/7.
Exactly. The legacy wells don't care that the frac crew took a week off. They keep flowing, and suddenly the operator has hundreds of thousands of barrels of toxic water surging to the surface, and the frac crew isn't there to absorb it.
So they have absolutely no choice but to divert it directly into NGL's disposal network.
It acts as an organic built-in hedge. When drilling activity is booming, NGL wins because the overall production base of the basin expands, increasing the long-term baseline flow. When drilling activity temporarily contracts, NGL wins because the recycling loop breaks, and a tidal wave of short-term volume floods their system.
It's just an incredible operational setup. You've got MVCs guaranteeing the baseline revenue, the factory model consolidation smoothing out the volatility, and the recycling break acting as a volume hedge. So, looking at the totality of this Q3 call, what is the bottom line for someone evaluating this equity?
If you strip away the noise and look strictly at the capital allocation, you have a highly defensive, cash-flowing infrastructure play that is actively punishing its own share count. I mean, they've eradicated 25% of their equity dilution by neutralizing those warrants and buying back the common float. They've dragged leverage down to 4x. And they are generating enough free cash flow to guide for $700 million in EBITDA next year.
All while utilizing SCADA-driven machine learning to physically optimize the network and avoid CapEx.
Right. That is the baseline. You buy it for the cash flow durability and the capital discipline. But the natural nuclear deal and the critical mineral extraction, that's the free call option. If the regulatory hurdles for small modular reactors prove too high, or the thermal distillation economics don't pan out, the core pipeline business is still printing cash.
But if they do pull off the nuclear desalination, the upside is structurally transformative. It's a midstream utility with a deep tech environmental lottery ticket attached.
It fundamentally redefines what the company is capable of becoming in the next decade.
Which is an incredible place to wrap up this deep dive. We started by looking at 3.5 million barrels of toxic waste being pushed through steel pipes in the desert. A gritty, old-school industrial reality.
And we ended up looking at aggressive capital structure arbitrage, fluid dynamics manipulated by AI, and nuclear-powered mineral extraction.
It forces you to completely rethink what a traditional energy logistics company actually looks like under the hood. And it leaves you with a really profound macro thought for everyone listening. We are staring down the barrel of a global water scarcity crisis. Freshwater is rapidly becoming the most critical asset on the planet.
Far more critical than hydrocarbons over a long enough timeline.
Exactly. So consider the irony here. The same heavy industrial operators that spend their days extracting dirty fossil fuels from the ground and dealing with toxic wastewater might be the exact entities that partner with next-generation nuclear tech to become the primary suppliers of clean municipal drinking water in the American Southwest.
The environmental liabilities of the 20th century could literally be engineered into the vital life support utilities of the 21st.
It's a wild paradigm shift, but after tearing apart the mechanics of this earnings call, it's a lot closer to reality than you might think. Keep questioning the structural realities of the market, keep looking for the asymmetries in the balance sheets, and we'll catch you on the next deep dive.